Hi, welcome back. Now, let's get into the details of the financial analysis. This video will explain how MSME's liquidity is calculated and assessed. If you don't have basic understanding of income statement and balance sheet, please check out theme 2-1 before going into this video. Out of the four main financial analysis category, let's take a look at liquidity. Liquidity shows the company's cash flow status. If the MSME's liquidity is low, the MSME may not have enough cash to run its business. What are some of the indicators to measure the liquidity of an MSME? Let's look at three ways to measure liquidity: cash turnover ratio, current ratio, and quick ratio. How do we calculate cash turnover ratio? Remember income statement and balance sheet? We need to use the numbers from there. Simply divide cash in the balance sheet with monthly sales from income statement. If this number is too low, the MSME may struggle to pay for operational costs like raw materials, employees' salary, etc. Cash turnover ratio can't be too high either because cash needs to be used effectively. The number should be just right. In order to calculate current ratio, we have to look at the balance sheet. You simply add all the current assets and divide it with short-term liabilities, short-term as in something within 12 months. You see, the MSME needs enough current assets to be able to cover short-term liabilities like loans or accounts payable, so this number shouldn't be too low either. Lastly, the quick ratio. The equation is quite similar to current ratio, only you subtract inventory from total current assets before dividing it by short-term liabilities. The reason we look at quick ratio on top of current ratio is because sometimes inventories don't sell quickly, so we only look at current assets that can turn into money fast. Current ratio should also not be too low to avoid the MSME from running out of cash. Now, let's try an exercise. A company that produces coffee has the following information. First, try making a balance sheet for them. Then, calculate the cash turnover ratio, current ratio, and quick ratio. Also, try to think about what the figures mean. Do you think this MSME has enough liquidity? To make this coffee-producing MSME's balance sheet, you can use a template like this. You can draw something similar to your notebook and work on the exercise there. Were you able to prepare the balance sheet correctly? This is how the balance sheet should look like. Once you prepare the balance sheet, you can calculate the liquidity indicators. For current turnover ratio, the answer is 1. This means this MSME barely has enough cash to cover its operational cost, which is not good. Current ratio is 1.4. This means that the MSME have enough cash to cover short-term liabilities like short-term loans and accounts payable. However, quick ratio is 0.8. So if the MSME cannot sell its coffee inventory as planned, it may run out of cash once short-term liabilities are paid off. Now that you learned how to measure liquidity of an MSME, you can go on to the next video.